Hey guys, Professor Lee here, and in this video I want to show you why $100,000 is your most important savings milestone and how my new motto is sprint to 100,000. I want each of you to get to 100,000 as fast as you can, and I'm going to show you why. So the first thing is 100,000 is actually 25% of 1 million, okay? And 1 million is actually almost 50% of 10 million. The math doesn't seem to add up there, right? Well, we're going to look at how that works, and that's through the miracle of compound interest, okay? Einstein was attributed with saying that compound interest is the eighth wonder of the world, and you are going to see why. And we're going to do this in a projection tool that I put together that you can actually access in the link in the description below, where you can do projections for yourself, okay? And so first I'm going to show you how 100,000 is your most important savings milestone, and then at the end of the video I'm going to show you the most tax efficient way to save $100,000. So let's say you're a 22-year-old, 10/17 is the date, and you're making $72,000, you just graduated. And let's say you plan on saving $10,000 in a brokerage account. So we're not keeping it in cash because we want to see growth. This is where the compound interest comes in. We're investing this in something like an index fund of S&P 500 stocks where you get a 7% rate of return. That's our assumed return. In our sprint to 100,000, you can see we reach 100,000 in 7.6 years. Well, how does that work? If we're doing 10,000 a year, wouldn't it be 10 years? Well, no, we get growth on each month that we're putting in money. We're putting in $833 a month, and that money is being invested in a fund that is paying us, we're getting a 7% return on that investment, okay? So it takes 7.6 years to reach 100,000. Well, to reach $1 million, it takes a total of about 30 years. So the difference, your first 100,000 was 7.6 years, and then it took 22 years to get another 900,000, and that's through the compound interest, that growth. So you can see 7.6 is 25% of that total of 30 years. That's how 100,000 is. You're 25% of the way to $1 million if you're investing at a 7% rate of return. And you can see in this graph, once you reach 100,000, this orange line is the money you're putting in, your investment, and the blue line is the total amount of money you have. And you can see the blue line grows exponentially where your investment doesn't change at all. You're still doing $833 a month forever, but that investment is growing at an exponential rate, and the inflection point you can see is right around 100,000 where you start to see that gap grow exponentially. That's why 100,000 is so important. How exponential is that growth? Well, once you hit $1 million, it takes you 30 years to hit $1 million, that growth is still exponential, so it only takes you another 31 years to reach $10 million, okay? So once you hit $1 million, you're halfway to 10 million, and you don't even change your investment. You're still investing $10,000 a year. That's the incredible thing with compound interest. Warren Buffett, there's an article, he built the majority of his wealth, 99% of his wealth, he accumulated after he was 65. It was after he built up this huge amount of wealth that compound interest just grows exponentially. That's what you want to apply to your life. If you save slowly and you hit 100,000 later on in life, you lose that opportunity. Time is your most valuable asset to use compound interest to your benefit. How valuable is that 100,000? Watch this. What if in this scenario you said, okay, I've been saving $833 a month. I'm going to stop once I hit 100,000. Okay? So you hit 100,000, you say, I hit my goal. I'm going to do zero for the rest of my career. So you stopped saving when you were 30. How will that affect your retirement savings? Is that going to mess you over completely? Many of you might think that. You've only saved 76,000. Well, you have 100,000 now because you invested 76 and it resulted in 100. Let's go back to our graph. Our line graph, which shows us that we still have this exponential growth. So what's the difference? Look at the orange line. You only saved 76,000, right? And then you stopped investing for the rest of your career. You can see the blue line still grows. The capital, because it's invested at 7%, you're still getting the compound interest. It takes you a little longer, right? Instead of 29 years to hit $1 million, it takes you 40 years, 10 more years, but you haven't invested anything else. Your money's doing the work for you, okay? And you hit 2 million in 50 years when you're 72. So you could literally invest for the 7 years, just 10,000 a year. You hit 100,000 and you stopped investing, If you're at 7% growth until you're 70 or whatever it is, you have $2 million. Okay, that's how important that first 100,000 is. Sprint to 100,000. Get there as fast as you can. Let's look at a tax efficient way. If you just did a brokerage account, it's going to take you 7.6 years, right? But that money is the difference between what you've invested and your total balance is going to be taxable, that growth. So you're going to be taxed on this difference, this white area. The difference between the orange line and the blue line is going to be taxable to you if it's in a brokerage account. I'm a tax professor. I love saving tax. Let's build this wealth in the most tax efficient way possible. How are we going to do that? Well, instead of putting it just in a normal brokerage account, let's put it in a few of my favorite tax efficient accounts. The first one is the health savings account. Watch my other video where I show you how the health savings account is my favorite retirement account out there. The tax savings, so many amazing benefits to an HSA. Okay, so let's say as a single individual you put in the max of $4,150. Okay, and this is an account where you get a tax deduction on the way in, so you actually save $1,400 in tax just that first year by putting it in an HSA. Okay, you could save that every year. So you save $1,400 in tax. And let's say we do the rest of the $10,000 that we want to save in a Roth IRA, right? This is an account where you don't get a deduction going in, but your money grows tax-free. So no matter what happens with the tax code, whatever changes happen, that is tax-free money to you. So let's say you put in the difference, $10,000 minus $4,150, and you put that in a Roth. That is going to result in $10,000 saved. But it only cost you $8,500 because you saved tax, okay? Technically, you're saving $8,500 a year, but you're getting $10,000 a year because of that tax savings, but now it's in tax-free accounts. The HSA, it's tax-free as long as it's used for medical, but it can convert to a traditional account later, and then the Roth just goes tax-free. Let's look at our sprint to 100K again. What's the difference between putting it in a brokerage and putting it in these tax-efficient accounts? Well, brokerage, there are differences where the brokerage account, you can get the money at any time. There's limitations on a Roth. You can only take out your contributions. HSA, you're taking out for medical. But in order to take advantage of compound interest, you need to leave the money in to grow. If you're taking it out, you're losing the advantage anyway. So what happens? You can see we're in the exact same place, right? For our first scenario where we're investing $10,000 a year, it only cost us $8,500 a year, but we're getting $10,000 a year. In 7.6 years, we hit 100. In 29 years, we hit $1 million. Okay. The cool difference is that gap between the orange and the blue line is now tax-free money. Okay. So we go over to our balance totals. When you hit $1 million, we got to scroll down pretty far, right? When we hit $1 million, we have $586,000 in Roth tax-free, and we have $416,000 that's tax-free as long as it's used for medical. Okay. Hopefully you don't have that much in medical, but the average, I think, for an American is in the 300,000 for their lifetime. So you could have all of that as tax-free money for your medical expenses, and rather than being taxed on the 700,000 difference or whatever it was. If you found this interesting, look at this other video that I have where I show you how to save $100,000 in less than 3 years on an average salary using tax-efficient accounts like this. And if this is information you think is awesome and you could use it and you know others could use it, give this video a like and subscribe. It helps me to spread this information more. There's a retirement crisis in the US and more people need to know this information. Have a good one, guys.